Yo, what's good, guys? Welcome to the chart for the British pound New Zealand dollar. Today, I'm going to be covering what Fibonacci is, how to use Fibonacci levels in your trading, um, and how you can help use it as a method of confluence in entering and exiting positions. So, let's get right into it. First of all, what is Fibonacci? Um, Sort of sounds like a type of pasta. And no surprise there, it was the idea of Fibonacci ratios was created by an Italian mathematician. Of course, he was Italian, and he created this idea of Fibonacci ratios about 1,000 years ago. And no, that's not an over exaggeration. It was in like 1100 and something, so almost 1,000 years ago basically. And what this idea was is there's a certain ratio of numbers that and a certain pattern that exists in all sorts of aspects of nature and in life. It's found in like seashells, leaves, plants, like all sorts of different things. It's a certain ratio of numbers that is commonly found in life, basically. And of course, there wasn't financial markets, back then, but there is now. And sometime in the 1900s, people wondered if they could apply these ratios to the markets, and maybe it could help explain the movements and help predict where it's going. And turned out it worked. It worked well, or worked decently, and so more people started adopting this, and now using Fibonacci ratios is a very common thing in trading. So basically, how it works is the market moves in waves, right? The market moves in waves. It goes up, down, up, down, up. It doesn't go, straight up, straight down, straight up, straight down. So basically, in these waves, there are pullbacks, and in a trend there are pullbacks, and so you can use these levels and ratios to sort of help predict where the pullback will end, and where it will start continuing back onto the trend. And then you can use Fibonacci extension levels to not predict the pullback, but predict where price might reach if it does continue on with the trend, aka where you should potentially take profits on your trade. One thing I just want to note before going forward, in a ranging market such as this, Fibonacci doesn't have a whole lot of use. There's really no reason to use Fibonacci if a market is ranging or consolidating. It's really for trends, trading trends. So basically, this is what a Fibonacci looks like. You draw it from a high point to a low point, or a low point to a high point if you're looking to go short, right? If it's in a downtrend. And again, it has to be a trend. Ranging, there's really no use. And my settings, because I'm sure someone might ask, these are my settings for the fib. The very common, obviously 0 and 1. And then the 0.382, 0.618, the 50 level, and these are a little less common, the 0.214 and 0.786. However, they are still useful, so I put them on there. And then for the extension levels, I have the 1.272, 1.618, and 2. Some people like to go higher up than 2 and keep going up till 3 and up till 4, but I don't really find any use for that, so I don't really do that. And some people like doing the negatives, right? So you have the 127.2, and then they have the negative of that, and then the negative 161.8. However, I just find that clutters up the charts, and there's really no reason to use that because I know which direction I'm looking at taking this, right? I know if I'm trying to go long or short. So I just draw my fib accordingly, and my extension levels will already be down there or up there. And some people ask sometimes, because they see that I've drawn it upside down, why I do that, and I tell them really the ratios are the same, whether it's this way or up this way, it's the same. The distance from the 78.6 to the 100 is the exact same distance as the 21.4 to the 0. The distance from the 38 to the 0 is the same as the 61 to that 100. And then, of course, the 50 is the same distance either way. So, honestly, it really doesn't matter in terms of your trading, which way you draw it, because it's going to be the same sort of distance and same place. So, yeah, the numbers might be different, but I mean, who cares? Like, it's still the same levels. So, and I just find that it just doesn't clutter up my chart as much if I have it going both ways. So yeah. So how you use this is, like I said, identify a trend. So, like I said here on GN, the pound New Zealand dollar, here we've had a nice uptrend for the last few months, right? I'm going to avoid this section just because, it's been kind of ugly recently. So, okay. So let's just go back to this area. So let's say it's starting to make higher highs, higher lows. And so, okay, it looks like a trend could be forming, right? And so what do? Let's say you're looking at it right here and you're like, okay, this could be the end of this wave. It's going to obviously make a pullback because that's how markets work. And you're going to try to find a place to buy, right? You want to be a buyer. You want to get in and take this thing long. So what do? You take your Fibonacci retracement tool and you draw it from the high of the wave, to the last low. So you could either draw it from this point or this point. There's really no right or wrong answer which one you draw it, but just for the sake of this, since we're on the H4, I'm just going to draw it from this low. If we're on the H1, the 1 hour time frame, I'd probably draw it from this low, but since we're on the H4, I'm just going to do it from there. So yeah, so we're going to draw it from this point here. And let's say it's going down, and the first sort of level I would probably look at, I would ignore the 78, just because that's usually not very reliable. So the first level I would be looking for is the 61.8. That's a very important level, and you want to look for a rejection. However, I don't recommend using this tool only for your trading to get into the market, because like we've seen at the 78.6 level, we did see some rejection, and so you would probably be tempted to get in right here. And if you did that, like, it does like rejecting at these levels, but a lot of times it will continue going down further. So, that will mean that you'll probably get in too early most of the time and have to take a lot of drawdown and have really wide stops on all your trades. And, that's not really preferable. So you want to use this tool in conjunction with other forms of technical analysis, like moving averages, zones, trend lines, all that good stuff. So like for this example, you're seeing we did see some rejection, right? We did see this level holding nicely. And so once you see that, you also want to look for, like I said, some more confluences. Like here, we could see this is a nice, it's been a nice area of resistance, now turned possible support. So that's a nice, confluence. And on top of that, we have the 200 moving average, which is a strong moving average, more so than the 50 and more so than the 100. So this is also a very strong level that it's seems to be holding nicely. Also, one thing I want to note about the moving averages, the higher the time frame for the most part, the stronger the moving average is. So like on the 15-minute time frame, the 200 won't be as strong as on the 4-hour time frame or the daily. So just something to note. So as you can see, we have a nice area of confluence. No trend lines that would really, we could really map out, but we have 3 confluences here, including the fib. So this would be a nice place to go long, right? Thanks to our handy dandy Fibonacci ratios and other confluences. Some people like to place it below the 38.2 just to give them some room, or some people like to even place it below the 21 or below the 0. But in case, just for this setup, if we were taking it, I'd probably put it below the 38.2 just because it gives, it's under these moving averages, it's under this zone, it gives some nice cushion. And moving on to the next area where we can use Fibonacci ratios to help our trading is with these extension levels. So obviously, like I said previously, we're looking to take this thing longer for this to continue the trend that we have been in, this uptrend. So as a last target, the 200 would be nice. However, I like to start off looking at the 127 and the 161, and just like we did in our entry, we want to look for confluences for our exits as well. So like I said, zones, moving averages, trend lines, whatever you can find to help line up these levels with another area of confluence to make it that much stronger as a TP area. So like here we can see we have a nice area of resistance, which sort of matches up with the 61.8, maybe a little bit sooner. So this would be a nice TP. I guess here we could see we have a level of support, so that would also be a nice first TP. And then lastly, this high sort of matches up with it, kind of. Well, I guess it'd be better off to use these. So yeah, then we have this level of resistance that kind of not really matches up. So as we can see, zones match up with these nicely. So yeah, I would look to take probably some partials there, and then take the rest off right there. And in the case of this trade, you would have caught almost the top of the move. It would have been nice, 500 pips, risking 100 pips, over a 5-to-1 risk reward ratio. That's a very solid trade with the help of using our Fibonacci tool. So it is very powerful. It's great, great to use, but you have to know when to use it. Like I said, it has to be a ranging market. You have to combine it with other confluences just to make it that much stronger. Right? Just using zones, just using trend lines, just using one method of technical analysis, you'll miss a lot of good setups. But if you combine multiple, then it just makes you that much more well-rounded as a trader, basically. So yeah, that's one example. I don't know, maybe we could probably find another trade using these Fibonacci ratios. So let's see. All right, so let's say we took our TP off right there, and we have this big, massive retracement. However, it obviously hasn't broken any lower lows, so we could still maybe determine this thing is in an uptrend, right? So just like we did previously, we're going to draw our Fibonacci from the high. Let's say it was like right here, right? So this was a big wave, and it's coming down for its retracement. We draw it from the high here down to the previous low. If you want, you could say this was the previous low, but if not, you could say this is the previous low. We're gonna go with this. So this is the previous low. It's just because this is a pretty long wick, so you could maybe determine that this was just a part of this uptrend. So also the retracement was kind of small. So obviously, like I said, there is no right or wrong with this. There's no rule book, but if you pay attention here, as you see, if we did draw it there, it matches up with the 21 level perfectly, or if we drew it from this low, it matches up with the 38 level perfectly. So either way, like would have been fine. But just for the sake of this, we're just gonna put it there. And as you see here, like I mentioned previously, you want to match things up with you want to match these levels up with other areas of confluence. So like here, it bounced off the 50, and it actually bounced almost 100 pips. So, I'm sure a lot of people are probably tempted to buy right there, but if they did, they would have to sustain a 140 pip drawdown or more, if their stop was, or if their stop was here, they would have got stopped out. Like I said, if you get in a little too early without extra confirmation, then you will have to have either really wide stops or, just get stopped out too early probably. So as we drew earlier, this nice level of support and, I guess it never really acted as resistance, but this nice area of support matched up with the 38 perfectly. So, it would be nice to take a long position here. Really, any of the times it touched would have been fine. And, maybe put your stop, just below the 100 moving average or something like that. Gives you 100 pips of, or if you wanted to place it below this low, 150 pips, which is kind of a big stop. It's up to you, but either way, you would have been okay, no matter really where you put your stop. And then, obviously, 600 pips is a really big move, so I probably wouldn't put my TP here, just because, that's a 1,000 pip move. You want to be somewhat realistic about your TPs, right? If you're on the H4 or a daily time frame, oftentimes the 127 or 161 will be good enough. You don't need to go with the, 200% extension level. So we used it to help our stop right below this level. We used it for our entry. Now we're using it for our TP using the extension levels, right? So you could either place it there or place it there. If it was me, honestly, I'd probably place it right here just because, it's above this high. It's a really great risk reward, great gain, 600 pips, can't complain. So as you see, this trade would have worked out perfectly, because we were in a trending market. We used our confluences great. However, one might TP early, a little bit early, just because you had this high, that high point there. So you could have possibly TP'd a little bit earlier than the 127, and you still would have made out with 500 pips. So yeah, because I know a lot of you guys were asking if I could do a video on how to use fibs. So I hope this helped. I hope, I know a lot of you guys already know how to use Fibonacci that follow me, but for those of you who might be a little bit newer and unfamiliar with how to use it, this is for you guys. And yeah, so main takeaways: use the Fibonacci in a ranging market. Not in a ranging market, in trending, trending price action. You want to use it. You can use it for finding a retracement and also for placing your take profits. And lastly, make sure you're using it with other confluences, because Fibonacci alone isn't the best tool, but if you combine it with other things, it is it's quite nice. So if you liked this video, feel free to give it a like. If you want to see more content like this, feel free to subscribe. I will be posting twice a week minimum, maybe 3-4 times. We'll see. Yeah, guys, thanks for watching, and I'll see you later.